Time for the latest earnings outlook now with Research Director Shiraz Mian. So Shiraz, what's your read so far in this Q3 earnings season? Too hot, too cold, just right?
I would say just right. It's not too bad. In fact, I would say that the earnings aren't great, but they aren't terrible either. And if you evaluate that in the context of how we came into the Q3 earnings season, you would recall that Q2 was very strong, essentially a bounce back from the extremely low levels where we had fallen in Q1 because of weather reasons. And since we had none of those issues in Q3, we were hoping that this earnings season will give us the true lay of the land on the earnings front. And the results that we have seen thus far seem to show that the true lay of the land isn't as great as we saw in Q2, but it isn't as bad as we saw in Q1 either. So growth is a little bit lower than what we saw in Q2, but it's definitely better than Q1 and along the lines of what we have been seeing in recent quarters.
Okay, run down the numbers for us.
Okay, I have this scorecard to share with folks. As of this morning, with all of the earnings reports included, we have 179 S&P 500 companies release results, 321 still to go. It includes everything that were reported this morning: Caterpillar and Southwest and Continental, United Continental.
This morning, October 23rd.
That's right,
okay.
Absolutely.
All right.
So as you guys could see, 46.8% of the market cap for the S&P 500 index has now reported results.
All right.
Meaning that we have a sizable enough sample from which to make judgments about how good or bad this earnings season has been. Earnings growth is 5.5% on 4.4% top line growth. 67.6% are beating EPS, and 45.8% are beating revenues. The second column in this chart, which shows the total market cap percentage, you could see that aerospace and conglomerates, they are effectively done. Technology, finance, industrial products, we have sizable sample sizes in those too. So this is the most current scorecard for the Q3 earnings season.
All right. What about rev growth? Higher?
Rev growth is actually doing good. Let me show this chart to you, and what this chart is actually showing, it compares the earnings and revenue growth rate for the 179 companies that have reported results as of this morning, and compares with what those same companies reported in the previous quarter, meaning 2014 Q2, and the average for the preceding 4 quarters. The average being the average through the second quarter of 2014. So you could see that the earnings growth rate, 5.5%, is lower than what we saw from this group of companies in Q2, lower than the 4-quarter average, but the revenue growth rate, 4.4%, is higher than what we saw for the same group of companies in Q2 and higher than the 4-quarter average. So absolutely, the revenue growth rate is tracking better. I must quickly add one thing, that the earnings growth rate, which is lower here, is primarily because of tough comparisons for Bank of America and the finance sector. If you exclude that, the earnings growth picture doesn't look as bad as this chart shows. I have that ex-Bank of America chart in my earnings trend report.
Okay. A few days ago on Zacks.com, though, you wrote that the beat ratios were below Q2 levels. I want to circle back to beats now. But we've had some big name beats, as you mentioned just a moment ago. You've had Caterpillar, you've had GM, you've had 3M.
That's right.
Big name beats,
That's right.
and some by a wide margin. What's going on?
Yeah, we have had some big name misses as well. You will recall IBM was a big miss. Coca-Cola was a big miss. McDonald's was. And here's a chart that compares the beat ratios for the 179 companies that have reported already to what the beat ratios for the same group of companies was in Q2 and the 4-quarter average. It runs parallel to the growth rate chart that I showed earlier. And as you could see that the 67.6% earnings beat ratio is below Q2 and below the 4-quarter average. Same on the revenue side. So 45.8% of the companies are beating top line estimates, which is below what we have seen from the same group of companies in recent quarters. So a few positive surprises both on the bottom as well as on the top line side.
All right, talk with me about the guidance front. What's going on there?
No change on the guidance front. Guidance has been, as we have been sharing with folks here repeatedly, has been weak. And here's a chart that I'm sharing with folks that shows the evolution of estimates for the current quarter, 2014 Q4. And the key driver for changes to estimates for Q4 are what companies are talking about on their earnings calls, primarily the guidance. And as you could see, the estimate for growth was 9.6% in late September, and it's dropped to 5.3% today. So the magnitude and the tone of guidance is as weak as it has been. We'll know more as the earnings season proceeds. There's the risk that guidance could be a shade weaker than what we have been seeing right now. But in any case, it's no better.
Well, you know, and just to follow up on that point real briefly, without trying to put you on the spot, if the guidance doesn't get any better, what is earnings going to tell us about the upcoming holiday season?
Well, there's a couple of other elements to the holiday season too. The earnings, these are international companies. They derive about 40% of their earnings from abroad. The outlook for the U.S. economy has been doing fairly good, particularly relative to trading partners. The job market is improving. We have had some material drop in oil prices lately too. That also bumps households' buying power. So we will know more in the coming days as data comes out. But the hope is that that this holiday shopping season should be better than what we have been seeing in recent years.
Okay, thanks for that. And in between these video updates on earnings season, please stick with Zacks.com's website. If you're not there already, you might want to bookmark it, because there is where you'll find the written earnings trends commentary penned by Shiraz. And it changes frequently. He now is inserting new scorecard updates in between the full commentaries. And his Ahead of Wall Street column every day breaks down all of the subtle nuances on a day-to-day basis, even beyond the scorecard. So all of that information for your review on Zacks.com. With Shiraz, I'm Terry Ruffalo.